Hey, this is Phil and it's your Friday video update. So once again, I had predicted last week that interest rates would improve, and sure enough, by the end of this week they have. And I'm actually looking for maybe some slight more improvement next week. So keep listening or give me a call if you're interested in what's happening, but good news right now on the interest rate front. Even bigger news this week was announced on Wednesday evening. And that is that the Consumer Financial Protection Bureau, the CFPB, rolled back the implementation of the new TRID rule. TRID standing for TILA RESPA Integrated Disclosures. That's the new rules that are going into effect that really broadly impacts the entire real estate industry. Now, I gave 2 trainings this week, yesterday and this morning. I spoke to over 50 real estate agents who found the information quite informative, and quite frankly, they were not aware of all the sweeping changes and how it impacted them. And so if you have not gone to a TRID presentation, you may want to seek another one out, and I'll be giving some more later, or give me a call and I'd be happy to possibly set up a meeting with you one-on-one and go over this. Now, lastly today, I wanted to speak to you about fixed rate mortgages versus adjustable rate mortgages. You know, what's gotten lost in the recent rise in the interest rates lately is that the spread between the fixed rates and the adjustable rate mortgages has widened. And ARMs now are looking more and more attractive. So I decided to take a look at a $300,000 purchase with a customer putting 5% down. Now, this would be maybe a typical first-time home buyer loan. And I decided to look at this loan using lender-paid mortgage insurance, which means I'm rolling the cost of the mortgage insurance into the interest rate. So looking at a customer and their fixed rate mortgage, I could give them a rate at 4 1/8% today on the $285,000 loan with the 5% down. Using the same loan, I could look at giving the customer 3.375 7-year ARM. Now, why did I pick 7-year ARM? I picked it because a lot of first-time home buyers don't live in their home for 7 years. Or maybe 7 years is a good number for them to be in that home. So the difference between the 30-year fixed and the 7-year ARM for the first 7 years is nothing. They're both fixed for 7 years. Now, I even went on to analyze the adjustable rate mortgage over years 8, 9, and 10. And to do that, I decided to increase the interest rate 2% in the first adjustment year, another 2% in year 9, and finally another 1% year 10, to reach the maximum allowable adjustment over the life of the loan of 5%. Now, trust me when I tell you, even looking through years 8, 9, and 10, the math still works on this, but I want to focus on the first 7 years. So comparing the 30-year fixed on the left-hand side, look at the interest rate of 4 1/8 yielding a monthly payment of principal and interest of $1,381. The adjustable rate mortgage with a rate of 3.375% yields a monthly payment of $1,260 in principal and interest. That's an immediate savings of $121 a month. Now, when you look at that alone, it makes sense for the borrower. But what could they do with that $121 a month? Well, I suggest they wisely invest it towards their principal balance each month. Focus on this center column and look at each of the years 1 through 7 and how much the difference between the remaining balance changes by applying the $121 to their monthly payment and towards the principal. That yields over the first 7 years an increase in equity of $15,811. That's nothing to sneeze at. But even further, because they chose the 3.375 adjustable rate mortgage, they're saving an additional $15,810 in interest they would have paid out over the first 7 years. That's over $31,000 in, quote, savings. Now, suppose the borrower decides they don't want to apply the $121 to their principal payment each month, and they decide just to save it. In the first 7 years, they've saved $10,164 in monthly payment. Any way you slice it, this makes sense. So if you have a client who's getting ready to purchase and their lender's not talking to them about the difference between an ARM and a fixed, maybe you're sending them to the wrong lender. I'm happy to talk to them, share this information with them, and help them analyze what might make sense for them. I hope this gave you a little insight that maybe you can impart some wisdom on a future client. Please forward and share this to anybody that you think might find it interesting. Thanks for listening. Happy Father's Day, and I will talk to you next week.